All right, let's talk about something that sounds, well, kind of impossible. Imagine a massive global banking industry that's built entirely on the idea of not charging interest. We're talking about a multi-trillion-dollar system that plays by a completely different set of rules than what most of us are used to. So that's the big question, right? How on earth can a bank, a business that seems to exist to lend money and collect interest, even function without that one key ingredient? It's a fantastic question. And the answer? Well, it opens up a whole different way of thinking about what money even is. Okay, so to get this, we have to start at the very foundation, which is Sharia, or Islamic law. Now, this isn't just a list of suggestions, it's a whole ethical and legal framework. And one of its absolute core rules for finance is a total ban on collecting or paying interest. Instead, it builds a system around ideas like fairness, transparency, and sharing in success. So, if that's the foundation, how do you actually build a bank on top of it? Well, it all starts with a really clear set of rules that guide every single transaction. It's not just about what you can't do, it's about creating a whole new ethical way of doing business. You can really break it down to three big no-nos. The first is riba, which is interest. The thinking here is that money is supposed to be a tool for exchange, not a product you can just rent out to make more money. That's seen as taking advantage. Second is gharar, which is a ban on wild speculation or gambling, basically deals with way too much uncertainty. And third is haram, which just means you steer clear of investing in businesses that are considered unethical, things like alcohol, weapons, you get the idea. And this right here is maybe the biggest philosophical shift of all. In conventional banking, if you take out a business loan and your business fails, well, tough luck. You still owe the bank every penny. The bank transferred all the risk to you. But in Islamic banking, the idea is risk sharing. The bank is more like a partner. If the venture does well, you both profit. If it fails, you both share in that loss. It completely flips the script. Okay, that's the theory. But what does this look like in the real world? Say you just want to buy a car. Let's walk through it. So one of the most common methods is called Murabaha, which is really just a cost plus sale. Here's how it works. Step one, you find the car you want. Let's say it costs $40,000. Step two, instead of loaning you the money, the Islamic bank goes and buys the car itself, directly from the seller for 40 grand. Step three, the bank then turns around and sells that same car to you for a higher, agreed-upon price, say $45,000. And finally, you pay the bank back in installments until that $45,000 is paid off. And this is the absolute key. See what happened there? The bank made a $5,000 profit, but it didn't come from interest on a loan. It came from the markup on the sale of a real physical thing, the car. The whole deal is based on trade, not on lending. Now that we've seen it in action, let's zoom out and put these two systems side by side. This is where you can really see the fundamental differences pop. Yeah, this table just lays it all out. Look at the split on every single point. The basic principle is interest-free versus interest-based. The source of profit is trade versus interest charges. Risk is shared versus pushed onto the client. And at the very bottom, you see the most fundamental difference. Is money just a tool for exchange, or is it a product that can be bought and sold for a profit? But of course, it's not all perfectly straightforward in practice. Nothing ever is, right? In the modern financial world, there's a pretty lively debate going on about how these ideals are actually applied. And just to give you a sense of the scale here, we are not talking about some tiny niche market. Back in 2014, these assets were already worth around $2 trillion. So this is a major player in the global economy, which is why the debate around it is so important. And this quote really gets to the heart of that modern debate. You have critics, and some of them are from inside the Islamic finance world, asking a tough question. They look at some of the really complex financial products out there and say, wait a minute, is this really any different? They argue that while the language and the structure are compliant on the surface, the end result can feel economically identical to a traditional loan with interest. So that leaves us with this final, fascinating question to think about. Is Islamic finance a truly fundamental alternative to the system we all know, built from the ground up on a different set of ethics? Or is it, at least in some of its modern forms, a really clever adaptation that uses different tools to get to a very similar place? It's a debate that's happening right now, and the answer is going to help shape the future of finance for everyone.